Basically today's lecture, we're mainly going to focus on one part of topic one of this course. And it's actually the last part that we're going to cover that I'm going to view as being testable for, say, things like the final exam. And so you really want to think about this as the last part of topic one that I view as being really first order important to you guys, kind of in the immediate future. And by immediate future, I mean like early on in your careers. So you'll notice there is going to be one module in this course that's in the syllabus that I am skipping. And again, I just want to justify the reason for doing that. It's that the stuff that was going to be done in this module, right? So today we'll be doing module 5, which is going to be, moving beyond the life cycle of startups and now talking about the funding life cycle and the process of exit, i.e. IPOs, acquisitions. That's what we'll focus on today. We'll try to go over some of the nitty-gritty practical aspects of both of those things, right? But in my slides, if you look at them, hopefully you look at them at some point, you'll see there is this module 6 called Venture Capital Firms and Funds, where I would do normally 3 things. I would talk about the structure of, it says structure of VC funds, but I should actually have been more specific. It would be structure of VC firms and funds, because those are 2 different things. Because you have VC firms, which are kind of like the entity owned usually by the general partners, i.e. the investing partners of a venture capital firm, right? And that is distinct from the actual funds that they manage. An individual firm will manage multiple funds over time if things are going well, right? So there's some nitty gritty to talk about those 2 things when you're thinking about being the person who manages a venture fund and who makes that business work. These are things that you kind of need to know. They're not that difficult to learn on your own, by the way. And then in addition to that, you start thinking about, well, you've got a venture firm, you've got an individual fund. How do you assess the performance of each of those things? And how do you try to go from an assessment of the historical performance of those things to some sense of whether you should be working with those firms via investments in future funds going forward, right? There's that question, right? It's really a question that is a question that is most predominantly asked by limited partners who invest into VC. These are typically things like pension funds, endowments, both for university endowments and charitable foundations and stuff like that, right? It's not like the retail investor who is like making that decision, because as a retail investor, almost always you cannot go and put your money in a venture fund. In fact, if a venture firm came to me and said, Giro, we would like you to invest in that fund, in our fund, I'm immediately worried, because that tells me one thing. It tells me that firm is so desperate to raise money that they're coming to me, because like a very, very prominent VC will only want to go to people who can write a really big check and who are sufficiently predictable as a source of a big check that not only are you sure they can write a big check today, they can write a big check 2 years from now, 6 years from now, when you'll go back and ask for the next check, right? So any venture fund that comes to like a small, even if I'm not like the smallest, right? But like comes to like moderate wealth human being like myself, it's like, to me, it's a first bad sign. It's not a guarantee that it's a bad fund, but it means they couldn't get it. They couldn't raise funds from more of the usual suspects, right? But whoever makes a decision, do I put money in a venture fund or not? Do I trust the skill and the expertise of a venture firm and its collective general partners, right? Needs to be thinking about how you look at past performance and try to use it to assess, is that good or bad? And so I was also going to plan to discuss that in this topic. And, in the interest of time, because I do know, my videos are maybe a little bit longer than I might have expected initially. Because of that, I know you guys are mindful about your own schedules, and I respect that. And so consequently, I've decided to strip this part out. I mean, I'm stripping it out like I don't want to refer to any specific disease or anything, because that would not be the right way to say it. It might be offensive. But in any case, I'm stripping it out. It's out of the course. I may, when time permits, post something on it. I have posted documents, including a handwritten PDF document that does kind of actually elaborate on this topic a bit, especially the second and third bullet points. And my slides do talk about the first bullet point. So you guys could actually probably get some value on it by just reviewing, but it won't be something I test on the exam. And again, just to repeat myself, I do also want to emphasize that you shouldn't necessarily feel that you're shortchanged in a way that matters early on in your career from this decision to strip this out, because actually all of the things that are discussed here, right? Thinking how should you structure your venture capital fund, and thinking about how you should assess the performance of a VC. These are actually questions that in the real world are asked by people who are far more senior than you guys will be in the next 5, 10 years, right? Like you can't leave McGill and launch your venture firm. Let me tell you that, right? So you don't need to think too much about structuring of a venture fund yet, right? So these are things that are things to visit and really later on in your careers. So maybe even if I taught it to you now and you had to like be aware of this stuff in 10 years, I don't even know what the likelihood that you would remember my course, my existence, and all that stuff anyway, right? So at a practical level, if there's one thing to strip out, I would say it's this. It is the single most droppable thing in the course. So it's the first thing I drop. So hopefully that justifies the slight change. But let's actually go now and talk about the stuff we're not dropping, right? Which is, as I said, this module 5. Just to recap what we've done in topic 1 so far, right? In topic 1 so far, we had our broad overview at the beginning. And then I would say we did deep dives into each of the 3 stages of the life cycle, right? Search for product market fit, search for go-to-market fit, and aggressive scaling. I say deep dive in the sense that we tried to talk about the most important things in each of those phases. And we tried to give concrete examples that I think gave some life to each of those challenges that I talked about and uncovered some of the nuance that exists in doing those things in the real world, right? Could we have done a deeper dive? Sure, right? If you were at Stanford, you would have an opportunity to take a full course on each of those phases, right? But we don't have that luxury here. I have just 1 semester with you guys, so we're trying to make the most of it. This is only part of the course, so we're going to actually do more financy stuff a little bit later on. But that's what we've wrapped up so far. Now what I want to do is do, not a deep dive. I would call it a mini dive on how this life cycle syncs up with the funding life cycle, right? So the different rounds that startups raise. Because one of the things I said, I think in our introductory class, was that one of the things that was pretty unique about the funding of startups is that it gets done in stages, as opposed to like much larger clumps of funding like we tend to see with more mature companies, right? So we'll talk a little bit about that not staggering, but that sequencing of financing in startups. And I'll give you a bit of a sense of what that usually looks like in the real world, right? So we'll talk a bit about that. And then the other another thing we'll talk about is the process of exit and the types of exits that occur in the real world. Exit is something that is super important with startups, especially from the perspective of investors in startups like VCs. Because the exit, which is, again, there's most notably it's IPOs and acquisitions. There's some new kind of flavors popping up in the market today. One of which I'll talk briefly about today, which is like the direct listing version of an IPO. One of which I will not talk about today in class, but I'm actually giving you guys a problem on in homework 1 for the course, which is the SPAC, the Special Purpose Acquisition Company channel for exiting, right? But we'll talk about some of those details. In terms of going into some of the nitty-gritty of the exit process, I'll be basically talking most about the nitty-gritty details involved in an IPO. I'm going to give you guys less information on the nitty-gritty process associated with acquisitions. This is mainly a combination of 2 reasons. One is the interest of time. The course is kind of overstuffed as it stands already. That's why we had to drop module 6. But in addition to that, Des Hotels does have, technically speaking, a course on acquisitions taught by David Schumacher. So that if you guys want to go a deeper dive into acquisitions in general, not just for startups, but all sorts of different types of companies, including, LBOs of cash cows and stuff like that, take his course. It's a wonderful course. But that's basically what we'll cover today. Folks okay with that? All right, well, let's go ahead and do this. So, as I said, first, we will talk about the funding life cycle of startups. You'll notice throughout this course, I have like some sort of weird obsession with the word life cycle. I think the word life cycle just works very nicely with startups because there's a clear evolution in the company as it goes from phase 1, phase 2, phase 3, different little subcomponents in phase 3. There's just a natural but very material change in the company. And so because of that, anything that you do in terms of analyzing a startup, you really need to analyze within the lens of the actual life cycle of the startup, because it's predictably different when it's a search for product market fit company than when it's a, 5th iteration of aggressive scaling company. And the way you analyze the company with finance tools, both in terms of valuation and fundraising, like those things are if someone tries to tell you it doesn't change in the life cycle, you should stop listening to them, because that just doesn't make sense. The idea that the answer would be the same, how you analyze, how you raise money, how you strategize for a startup, that it would always be the same regardless of whether it's an early stage company or late stage, like that defies logic, right? So that's why I'm going to be using the word life cycle so many times in the course, because every time we're analyzing something, I'm going to ask this question, like, how does our analysis change if it's a really early stage company versus a later stage company versus a later stage company versus like when it becomes public, right? And so, first example of us thinking about things that way is this funding question, right? The funding life cycle. And the basic idea is, like I say, the funding life cycle, because the way funding happens and the characteristics of funding that we see naturally evolves with the actual life cycle of the startup that we've already talked about. Okay, so all I'm going to do here in terms of talking about the funding, I want to give you guys just a practical description of how funding rounds differ and evolve as a company, a startup matures from really early stage to, later as things hopefully continue to go well. Again, the first thing that we want to remember is this idea of staggered funding. You raise multiple rounds of funding, right? So if a startup starts, it doesn't say to itself, oh, how much money do I need to go from 0 to public company? Oh, to do that, I'll need like $400 million. Let me go raise $400 million. No, it doesn't work out that way. No one's going to give you $400 million anyway, so that's a pipe dream, right? What's going to happen is like you're going to be able to raise just enough money to try to show that what you're doing is worthwhile, right? So you'll raise a certain amount, and the goal is going to be to validate the kinds of things that you want to validate in the search for product market fit, right? And then once you validate that, once you show like, I was good enough to do this, my idea is promising enough that it looks okay so far, then you can raise your next round. What it does is it gives the opportunity to investors to cut their losses if what you're doing ends up being bonkers, right? None of us know whether it's bonkers yet, right? We hope it's the opposite of bonkers. I don't know what opposite of bonkers. I think the problem with the word bonkers is it can mean both something really, really good or really, really bad. Like, right, so like the good bonkers or the bad bonkers. You want to be able to, speed up your bets if it's the good bonkers, and you want to be able to shut things down if it's bad bonkers, right? It's the notion of a real option. If you guys have studied like a finance 2 or something like that, you have at least probably seen that theme. But yeah, so like the goals early on with the funding rounds is just to show that there's a chance it's the good bonkers, right? But what's kind of the consequence of this kind of thinking, right? You start to see that there's a logical justification for wanting to raise, loosely speaking, as little money as you need to validate the next bit of evidence of good bonkers, right? And so, and that you don't want to raise, or you won't be able to raise too much more than that, because the investors want to be able to cut their losses if things start to look like the bad bonkers, right? So how does this actually, like what I just described to you guys is I've said it in a kind of abstract way, right? What does this actually look like in planet Earth, right? Well, the way it looks like is, you raise a first round. Usually for a startup, you raise a first round. It might be while you're building an MVP and before you actually have it and have launched it. Sometimes you raise money only after you have an MVP and have validated it a bit. Okay, let's think of the scenario where you haven't built your product yet. It's basically still an idea, right? And you need money to build even the MVP, right? Well, generally when that happens, we call this a pre-seed round. So not every startup is going to raise a pre-seed, okay? And usually a pre-seed, the goal is to build an MVP, that first product that you kind of try to start validating a little bit in the market. And generally that round involves you raising enough money to survive for about 1 to 1.5 years. I say 0 to 1 here. 0 to 1 here is like how much time we usually think this period would last. When you raise money, you say to yourself, how much do I think I need if I'm able to build this in the amount of time that I think? So I think it'll take me a year, cost me about $100K a year to build this. I'll raise, $100K. And you might try to raise a little bit more than that to have a margin of safety, because most of the time when we think as optimistic entrepreneurs that it'll take us a year, it'll probably take us a year and a half, right? So you always kind of ask yourself, in order to make this progress, so in this case, a pre-seed, success is I developed an MVP and the MVP looks kind of good. It looks good enough. It's not a piece of shit, right? And so you ask, like, how much do I think I need to get to that? And you generally raise that plus a margin. Did you have a question, Kanish?
Yeah, I did. So call it you're an investor at a pre-seed level and you're investing in an entrepreneur, because at that point you're investing more in a person than you are in a product. You're investing in that person and their idea. So from your experience, do you know if they put any sort of condition saying that you can't be looking for or you can't be working full-time somewhere else, or you can't be doing something else? Because if I'm giving this person, call it $100K to develop this product for the next year and a half, I want them to be fully committed. So is there any sort of contractual obligation they put into place there, or is it just understanding because it's usually from friends and family?
Yeah. So I think I haven't seen this put in any formal way in the investment contract, right? But early on, this is really a relationship business, right? And so definitely you'll have settings where the VC will say, okay, I'm willing to fund you, but you need to commit to doing this full time. And it might not be written in the contract, but I'm not sending you the check until you promise, and then I'll take you at your word. And certainly there are examples where people renege on their word. But when people renege on their word, this is a small world. If you screw me that way, I will tell everyone I know that you can't, that they can't trust you. That's not going to help you, trust me. Because more likely than not at this stage, you're going to, most of the investments at this stage are going to end up failing, right? So those entrepreneurs, they're probably, they should know, if they're not completely delusional, that there's a very real chance that that's not going to be their life payday, and they'll have to come and raise money again, right? So it's not really it's kind of reckless on the part of an entrepreneur to kind of not stick to their word in this stage. The contracts here do tend to be fairly simplistic, and there's a reason why they're simplistic, because the moment you start putting X, Y, and Z in a contract, guess what? The legal fees go up, right? And if I'm sending you a check for $50,000, we probably don't want legal fees to eat on like 35,000 of that. That seems to kind of go again, like that seems to run counter to the point of it all, right? So there's like a justification why these tend to be much more informal contracts. I mean, you have plenty of investments here where it's like there's nothing legally formalized about it. With friends and family, that's not unusual, right? Another thing that you said, by the way, is that it's a lot of the investment case from the part of the person writing the check is about the person at this stage, and that's definitely true. We will talk about this in topic 2 when we talk about the qualitative evaluation of startups, because when you qualitatively evaluate a startup, you know, you can evaluate the project and you can evaluate the people, right? And so you should really think about those two things. And then the question is, well, if you've got those two things, what do you put more weight on, right? Definitely, without a doubt, you look at the data, anecdotal data, you know, in interviewing VCs and stuff like that. What you find is that the earlier the investment, the more weight on the founders, and the later the investment, progressively more weight on the project and what its prospects look like, right? You're absolutely right that it's about people here. But like in terms of like saying like, well, it's all about the person, I better make sure the person is committed, that gets done really informal. Again, I'm sure you can find some examples where like it was written in the contract, but that's going to be like big time the exception rather than the rule. It probably, I would venture a guess, a rarity. So far, so good?
Yeah. I had a question just before you continue, if I can. I just want to confirm that the 0 to 1 years, the 1 to 2 years, that's basically like how long you expect, you know, what the funds you're raising, that's how long you expect to use those specific funds for, right? That's not how long you're in the market to raise those funds.
Oh yeah, no. So what my range here is kind of like how long you expect that stage to last.
Right. And so kind of playing off of something I think I was asking either last week or earlier this week, like, is there any sort of kind of norm that you would expect to like raise pre-seed, seed, Series A? Like how long you would expect to try and actually start? How long is it going to take you to raise those funds?
Yeah, I mean, like, so this is what I would say. Like, again, so first of all, everything I'm saying right now, think of it as a rule of thumb, not a golden rule. So let's be clear. So you can always find exceptions to what I say, okay? But, right, my goal here is just to show you what is typical, not to encompass every possible outcome, right? But, you know, with that caveat, you know, what I would say is an MVP build takes usually between 0 and 1 years, right? And usually what most people will advocate is take the amount of time you think it'll take for you to achieve the goal of this funding round. The goal of a pre-seed is build the MVP. Take that amount of time and add like up to 50% more than that to give you a little bit of breathing room, a little bit of wiggle room, a little bit of an opportunity to stumble along the way, and a little bit of recognition that you don't really know how long it'll take, right? So if you think it'll take you 6 months, right, maybe raise for 9 months, right? That would be like an off-the-shelf bit of advice that I feel extremely confident most VCs would give, or most advisors would give to a startup. Okay? And by the way, I would not I say 0 to 1 here. This is not a very scientifically calibrated number. This is an anecdotal number. Okay? But what I will say is MVP build tends to be shorter than the other things. That's definitely true, right? Now, again, and just keep in mind, some startups don't need money to build their MVP, right? The founder is building it on the side while they're working, right? Or it's a project where you can build a very dinky MVP that gets launched really quick. Like you can't do that for some startups, right? If you're like a biotech startup, you cannot launch a dinky MVP like that, right? So, right, it depends on the startup. But some, you know, for some startups, they actually don't need to raise money before they launch an MVP. I mean, if you're able to do that, if you're able to launch an MVP without raising money, good for you. Do that. It'll save you equity, right? And it'll teach you to be lean as well, right? So not every startup raises a pre-seed. The ones that need the money to build the MVP raise a pre-seed. Now, after that, or for some companies, if they built the pre-seed on their own, this will be potentially their first funding round, is a seed round. And a seed round, most typically, the goal of the seed round is to reach product market fit. Okay? So that's typically, you budget 1 to 2 years for that, and you raise a little bit of a premium above that, as I said, right? So that idea that you raise like 50% more, like that's a pretty uniform bit of advice that's given for all the early rounds. I think once you get to much later rounds, you don't necessarily raise 50% more than you think, right? You'll go a little bit less than that. Maybe you'll go, here I'm being super anecdotal, but let's call it 10 to 25% more, right? But the early rounds, raising 50% more than what, because you're also more likely to be overconfident early on because you're operating with so little data, right? So there's a bunch of rationalizations for a lot of these things, right? But yeah, seed stage, usually search for product market fit. By the way, I'll mention another thing. A typical pre-seed is going to be between 0 to 100K is typically what you see. As I said, pre-product, and most of the time it's raised by it's friends and family money. It's not professional investor money, with the only caveat being like there's some like adventurous angel investors that'll go pre-seed. But that's actually like, that's most angels won't do that actually. Most angel investors, and certainly almost every VC, will only raise once they see once they see a product. I mean, unless it's one of these rare startups where like it's so expensive to build a product and everyone really believes in the market. Okay. But that's kind of what a pre-seed typically looks like. You see some instances where a pre-seed will raise more money. It's usually someone that is like, that everyone believes in as a founder. So they're just competing to like bet in that human, right? Or it's a setting where, someone has had success before. And so sometimes you can raise a lot of money before you have a product. Like, one example of that would be a company like a company like Jet.com. So Jet.com was basically tried to do Amazon meets Costco. And it was founded by someone who had built another e-commerce store during the first .com era that got acquired for a very sizable exit by Amazon, and who had then gone and worked and played important e-commerce roles at Amazon for many, many years. And so when he said, I want to do Costco meets Amazon, like everyone was listening, right? And so he was able to raise a ton of money before he launched the store. $60 million, I think, was the amount. But that's just a complete exception to the rule because of the special characteristics of the founder, right? But for normal founders, 0 to 100K is maybe what you can expect at this stage. Meanwhile, a seed stage will be, you see a range 200K to $2 million. You'll also see geographic variation in these numbers. So like the range is going to be systematically higher in the Bay Area than it'll be in, say, Montreal, right? And even Montreal will be higher than like non-startup hubs, for instance, right? Montreal maybe barely qualifies, but still qualifies as an actual like recognizable startup ecosystem. So just also note that there's geographic variation in these things as well. But again, remember the seed stage, as I said, is post MVP. So this is where you're launching and you're trying to see how does the market react to this? And that's usually raised by angel investors. Some, again, adventurous VCs are also willing to make seed stage investments, but not every early stage VC makes seed investments, right? So actually this points out another thing, just practical bit of advice for anyone who's eventually someday a founder, right? You always want to do your due diligence on VCs. And one of the things you want to do as due diligence for VCs is you want to ascertain whether they actually have a track record of making investments into companies that are at the same stage of the life cycle as you. If they have never made such an investment, it's actually pretty unlikely that they'll make an investment in you, right? So that's actually, something that you always want to do. You want to look like, for a given VC, which companies have they invested in? And you also want to pay close attention on, well, when did they invest in those companies, right? Did they invest in Airbnb like in the early days or later on? Like, those are two completely different types of VCs, right? You don't want to approach someone who invested in Airbnb in the Series F round and ask them for a seed stage investment. You know, like most likely they'll look at you and say, wow, you really have not done your research. You do not understand how this works. So, you know, that's why I think it's important in describing this life cycle that we also kind of keep in mind, right? Not just how much is raised for how much time at which stage, but also keep track of like who the usual suspects to provide this money are, because there's a life cycle of that too. I just didn't put that part in my slides. All right. So far, so good? Yeah. I mean, this is just descriptive at the end of the day, but it's nice to have it all in one place, I guess. I didn't know it until I looked into it myself as well. So, so then afterwards, you have, you know, usually something called a Series A. I'll actually say one other thing. Pre-seed and seed stage tend to be much simpler financial contracts. So they're not going to be like these long financial contracts that have a bunch of clauses in them. And we'll get into more of those details in topic 4. Okay, but think of these as being pretty simple, rudimentary investment contracts. Once you get to the letters, Series A, Series B to Z, it could, in theory, although I don't think it's ever happened, it could go to beyond Z, in theory. Once you get to the letters, the contracts are getting serious, okay? And there's going to be actually a lot of clauses in the contract. And again, we'll talk about those things in topic 4, right? But that's why there's the letter. Letter A just means this is the start of the serious stuff. And the raising always goes letter sequencing. So if the first serious thing you raise is an A, the second serious thing you raise is a B, so on and so forth. Okay? Now, because of that, the lettering can be like what I'm describing as the rule of thumb meaning of the lettering you can find plenty of counter examples to that in practice. Because the thing is, like, look, let's say you're an example of a startup. Like, for some reason or another, the first time you need to raise VC, you're already like way into aggressive scaling. Like, you just happened to start a company at the right time. It kind of exploded. You didn't need to raise any money. And now you're like, you know what? This is like doing so amazing in Canada. Let's go global. Oh, wait a second. I need to raise money to go global. Well, in that case, you would raise your first serious funding round, but it's not like a typical Series A. It would be like more reflective of a typical Series C or D or something like that. But even though you look more like a Series C or D, your thing would still be called a Series A because you start with the letter A. That's the legal convention, right? I can give you an example from that in Montreal, Lightspeed Point of Sale. Lightspeed Point of Sale, their first VC investment, which was a Series A investment by a prominent Bay Area firm and a prominent Montreal firm, Inovia. That was not a typical Series A. They looked more like a growth stage, like an aggressive scaling stage, and not at the beginning of aggressive scaling, a little bit into it. But it was still called the Series A. So just keep in mind the naming in practice can be a little bit more nuanced than what I'm saying in this kind of rule of thumb description of things, right? So don't just automatically say to yourself, oh, this company's a Series A. It must be looking for go-to-market fit. That's not always true. Lightspeed Point of Sale was not looking for go-to-market fit when they raised their Series A. Like other examples of companies that raised a Series A but were much more mature than a typical Series A. Like one example, maybe I'll give you guys an example from international. I'll give you an example from the US. So international, Atlassian, right? So I'm not going to tell you guys about Atlassian, but it's an easy Google search. It's an important company. In the US, relatively recent, you know, pretty advanced. I think they got acquired recently. There's Qualtrics. Okay, so these are actually, I mean, the ones that kind of fall into that camp, by the way, tend to be companies that didn't necessarily think of themselves as a startup when they started, and just basically stumbled in to, I mean, it makes it sound dumber than it really is, but like that, like just, you know, the ambition of the founder evolved into startup ambition as opposed to being startup ambition right from the get-go. So if you talk to Dax Da Silva, the founder, CEO of Lightspeed Point of Sale, he'll tell you, like, he wasn't entering in, launching Lightspeed Point of Sale saying like, this is going to be a high-flying startup. We're eventually going public, well over $1 billion, you know, in both the Canadian and the US stock market. Like, that's not that wasn't the vision he had when he started, right? But eventually he realized like that was actually potentially a realistic vision. And that's when he switched into that mode, right?
Yeah.
Everything I'm going to say now is really more a description of the typical path, as opposed to these slightly idiosyncratic paths like a Lightspeed Point of Sale, like a Qualtrics, like a Atlassian. Okay. And by the way, I'm mentioning 3 examples. You could find literally, you know, hundreds, right? So the exception is not a rarity here, but I think it's good to know what the canonical path looks like. Kanish, did you have a question?
Yeah. My question was, when you go into Series A, you said that the length of the contract start to change. Are the how much does the style of equity differ as you move to later stages?
Yeah, you know what? Let's just defer that question. I'm happy to answer it offline, but we're gonna treat that in all its glory in topic 4. So in the interest of time, I'll defer that to later. That's not my goal right now. My goal right now is overview about the syncing as opposed to the details of the contract, because that's a big can of worms that I can take hours to answer to you. Okay, so let's just kind of stick to the kind of more high level stuff here and start talking about, again, what the typical named round kind of looks like. And the Series A is typically you've got some evidence of product market fit. Okay. And you're trying to reach go-to-market fit, right? So Series A usually is try to conquer phase 2, right? And it'll typically be a funding round between 1 and 15 million. We'll probably capture 90% of what you see there. And this is going to be firmly like any early stage VC is willing to make an investment in search for go-to-market fit. If they're not willing to invest in search for go-to-market fit, it's either because they think the company that's pitching to them has no chance of reaching it, or they have deluded themselves into thinking that they're an early stage investor. It's one of those 2 things, right? But early stage VCs will invest it. And you will also have what we call stage agnostic VCs, because there's differences across different VCs. Some VCs specialize in early stage, some VCs specialize in later stage, and some invest across the spectrum. When they're investing across the spectrum, they will be called stage agnostic. So let me maybe give some examples. And I do recommend students in this course to become familiar with some of the prominent US and Canadian VCs at least. In terms of the US, a prominent stage agnostic VC would be Andreessen Horowitz, right? A prominent early stage only VC would be Benchmark, for instance. A prominent only late stage VC, let's see. Those tend to be a little bit less well known, just because like the most sexy stories of VC investments are always early stage. Because it's in early stage that you'll see a 1000x return. You will never see a 1000x return in late stage. So all the famous ones are either early stage or stage agnostic. But one example of a relatively well-regarded late stage VC that almost entirely invests late stage, they will occasionally do a borderline early stage, is Summit Partners. They're known as being pretty quantitative as a VC shop. But so like, yeah, there's not all VCs are the same, right? But yeah, so when we say like VCs will invest in it, you always want to think like, well, which types of VCs are you talking about? But yeah, so early stage is either Series A is either stage agnostic or early stage. Sometimes you'll see angel investors make follow-on investments here too, but only really the angel investors who can write sizable checks. Then after you've done Series A, look, in an ideal circumstance, you've raised your Series A before you've run out of money, you've achieved go-to-market fit, and then you start aggressive scaling and you raise a Series B. And remember I said in the last lecture, really aggressive scaling is kind of like something that goes in waves, right? You say, first, I will aggressively scale in this thing that I figured out, and we'll try to figure out the next go-to-market. And then I'll do that again. Then I'll do that again. And hopefully I can keep doing that for a long time, right? That's what allows you to scale aggressively, of course. And so you have multiple of these rounds. That's why I say Series B through Z, is that this could be many, many rounds, right? Because each round you have kind of you have a specific expansion in mind, right? So, and each of those rounds, sorry, 1 second, can range between $10 million and $1 billion. So the mega rounds are all aggressive scaling rounds, for the most part. Again, you can always find some counter examples, but the mega rounds almost entirely are. Show that you're succeeding in getting more and more and more market traction in as predictable of a manner as possible. Right? So that's the typical size of individual rounds. The early, perhaps unsurprisingly, the early phase 3 rounds are going to tend to be smaller than the later phase 3 rounds. Right? That's why, typically what you see is fundraising gets progressively larger over time. Any questions about this?
Yeah, I had a quick question just for further context. How many VCs are we talking that are investing in a round? So let's say in Series A, if you're raising $1 to $15 million, how many VCs are giving you capital?
So one thing that Mike is pointing out is that in an individual funding round, it's usually done in a syndicate, meaning that there's more than one investor in the round. Look, rule of thumb, early rounds, fewer syndicate members, later stages, more investors. And one of the reasons being the checks are larger and larger and larger, so it becomes harder and harder for a small number of investors to stomach, okay? There aren't many investors like SoftBank. Oh, SoftBank is probably the best example of a late stage investor. Whether you call it VC or whether you call it, new era growth stage private equity, and call it what you will, right? But they basically make late stage investments, and they're one of the few that'll write pretty crazy sized checks all on their own. Whether that's been working well for them or not is a very open or maybe not so open question. Not sure they're too happy about what's happening with WeWork. Right? But late stage investor. People generally think WeWork is kind of really kind of had an impact in changing some of what we kind of see in the late stage over the last 5 years, maybe even 10 years at this stage. Right? But again, at this stage here, I don't want to get too much into this kind of nitty gritty stuff. Let's just remember, Series B to Z, right? The goal of each of these, right? There's many funding rounds happening here. That's why I say B to Z. And, right, the goal each round, and it's generally laid out in pretty clear detail, is to penetrate a specific go-to-market that you validated in Series A, for instance, and then to find another, promising channel to get even more expansion, right? The goal is I think I said it a few times last lecture, the goal is twofold like that, right? And the aggregate of all this aggressive scaling, most of the time that's between 2 to 10 years. Again, you will find some outliers. You'll find some stuff where it was more than 10 years. That's always possible. And maybe you'll find something where something was able to IPO very fast. During the .com bubble, so late 90s, beginning of 2000s, I mean, you had companies doing their IPO, you know, in search for product market fit. So that means by definition, these were 0, 0 before exit, right? Because I'm defining exit as once you're done raising money from VCs and VC-like investors. Yeah. So Series B through Z, it tends to be more late stage focused VCs or stage agnostic VCs. I will also talk in a slide or two about some modern new entrants into the late stage funding market as well. So I'll talk a bit about that at a practical level relatively shortly. But then, you know, after you're done with your VC-like investment rounds, it's by definition, you know, you're done with those rounds because you've moved beyond VC-like investment, which basically happens once you have an exit event, right? Where an exit event can usually be classified either as an acquisition or an IPO, right? And it's really this exit event that, loosely speaking, you know, provides that financial payout to the investors of the company. Whether it provides it right away or with a little bit of a lag is an open question, right? Because like when an IPO happens, the VCs that invested in a company, they don't sell out immediately because they're actually locked up and they need to keep their shares for a period of time until like, I'll talk about that process when I talk about the IPO. But basically when an exit happens, the opportunity for a liquidity event to the investor is at least on the horizon, right? And we'll talk about that. But the exit process itself also takes time. 0 to 2 years is a range that I've heard as being reasonable for how long, you know, it might take for an exit to occur once the startup actually starts actively looking to exit. So as I mentioned, names of rounds can be misleading. I think I made that pretty clear. Timelines assume achieving goals from round to round, right? Because there's uncertainty, you might raise a Series A, try to get go to market fit, but you don't quite get there. And you start running out of money. You need to raise another funding round. Then you'll raise a Series B, but that Series B looks more like a Series A, right? So there are some Series Bs where it's still a go-to-market fit round, right? So this progression here, assume that you are making linear progress. That's not guaranteed, right? There's so much uncertainty. There's no way it can be linear all the time, right? And let's keep in mind, outlier rounds are possible. I gave the example of Jet.com. So you guys can go and do an online search on Jet.com. By the way, Jet.com eventually got acquired for, I think, $3 billion by Walmart. So like Walmart basically acquired Jet.com to help shore up their e-commerce. So you guys can read up about that. But that's just, you know, to me, Jet.com is a great example of an outlier round. They were able to, their first round of funding, as I said, it was pre-product and it was such a serious round. I said they raised 60 million, not 0 to 100K. But because it was a 60 million round, it was actually called a Series A. Because you don't give someone $60 million, no matter how famous they are, without a pretty tight contract, right? So, right, that's just to give you guys a bit of a sense that, like, don't be so naive as to think that what I said on this slide is a golden rule. It is a rule of thumb, okay? By the way, another thing I'll mention is what I'm saying is relatively current to our current time. So, you know, think like these numbers are kind of accurate from like the 2015 to 2020 era, right? These numbers and the labeling has changed a bit over time. So like if we look like 15 years ago, 20 years ago, there was no such thing as a pre-seed. So what people call a pre-seed now used to be called a seed. And what used to be called a seed used to be called a Series A. The world has changed a bit in that regard. And it's mainly changed because of the rise of angel investing, right? But you know, these are just like little things that are useful to be aware of. But in terms of current market conditions, this is pretty representative, okay? Couple of things written about funding rounds by people with far more real world experience than me. Great blog article by Elad Gil. Elad is founder of Mixer Labs, which got acquired by Twitter, founder of Color Genomics, and now just really a very well-regarded startup advisor. He's one of the blog people on the operator side that I put in my list of go-tos. He's just got a lot of nice clarity in his discussion of really important startup-related topics, and especially in terms of giving advice to founders. So highly recommend looking at his stuff. This is just a link to a blog post that he wrote specifically about funding rounds. This is a YouTube video of a presentation given by another founder, Aaron Patzer. Aaron Patzer was the founder of Mint.com, which you guys, I would think you guys have heard of it. It was eventually acquired for about almost $200 million by Intuit after just a Series A. He talks about how he approached his early funding rounds. I think he did 2 funding rounds for Mint.com. And in particular, he talks about how he decided how much to raise. And basically what he says is very much aligned with what I said. Try to figure out how much time it's going to take you to be able to raise your next round, tabulate that up semi-carefully, and then add a little premium to it. I mean, you'll see, he says it and he's done it. So, you know, if you don't trust me, trust him. He looks pretty serious in this picture. So in any case, let's see, what do I want to say next? I want to talk a little bit about how this funding life cycle has been changing over time, because what I just described to you is the way it looks right now. But another thing that I think is important for me to tell you guys, just in terms of you guys having an appreciation of history, is that this funding life cycle now looks super different than what it did, say, before the early 2000s. So in the early 2000s, it's not just that the labels were different. Startups would raise much fewer funding rounds than they do now. I mean, go look at companies like Airbnb, Uber, or pretty much any company that's gone public. You'll notice they raised a lot of funding. I think like Uber raised 18 or more funding. At some point I stopped counting, right? 18 rounds. They're almost getting to the letter Z, right? Like you did not see this prior to the early 2000s. Like, and in fact, like during the dot-com bubble, you would see companies raise 1 round of funding, then go public, right? Like Amazon raised a seed round and a Series A, then they had their IPO, right? Same thing, like eBay, I think eBay just raised the Series A, and they might have barely touched that money, right? Like if you look at the capital structure, like the number of funding rounds, for instance, that companies going public in the early 2000s, late 90s, if you look at the number of funding rounds they had raised, and you look at the number of funding rounds that companies going public now raised, you'll be like, Jesus Christ, these must be 2 different universes. And they are. They're different universes because the universe doesn't stay steady over time, apparently. Now the question is, why, right? Why has there been such a dramatic shift? So I think I'll tell you guys a bit about that, because I think I have a view, and I would say it's relatively consensus amongst you know, even practitioners, so long as they think about the topic. And I think there's like a few factors that have led to this change. And the way I would characterize this change is that there has been a stretching out of late stage funding. In other words, late stage funding lasts longer than it used to. In other words, companies stay private longer, okay? And I think the main culprit for that happening is basically the dot-com bubble. I do highly recommend. It used to be, when I first started teaching, I could tell people about the dot-com bubble and they'd kind of remember, because I used to teach MBAs and I started teaching in, you know, 2008, actually. And so it used to be that my students were older than me. And so if I remembered it, they remembered it. Now it's a little bit hit or miss with you guys because you're younger and I get it. but I would be I do recommend that students be a bit of a history buff when it comes to really important market events. Like, I think there is value for you guys to think, like, how did the world of investing change before versus after dot-com bubble, before, after the recent financial crisis? You know, in 5-10 years, maybe we'll say before and after our current environment, you know, or before and after the crash of '87, before and after the Great Depression, right? All of these things, right? Big events that just led to massive changes are things that are worthwhile to study for a variety of reasons. For our context, because VC is a relatively young industry, well, VC did not exist during the Great Depression, so there's no real point to go before and after on that one, right? But this is one of these major events that really marked fundamental changes in VC and the process of going public. And so maybe I'll give you guys, okay, it says final project on my slide. That's a typo. That should not exist there. You guys don't worry, don't panic, no final project. At some point in time, I had a final project around it, but I just kind of have decided that it's not valuable enough to make an entire deliverable around it. The point itself is pretty simple, so I'll explain it to you guys in words right now. Basically, what happened with the dot-com bubble? Dot-com bubble, basically markets believed, holy cow, internet is going to revolutionize everything. By the way, you know, that ended up happening, but it didn't quite happen the way people expected. And so people just basically were like, anything that is doing something over the internet is glorious, fabulous, worth putting our money in as soon as possible. And one of the reasons why, and when I say everybody, I mean investors in the public market, including retail investors like you and I, and also institutional investors, everyone was drinking the Kool-Aid, right? And of course, everyone wanted to drink the Kool-Aid because, like, companies that were going public that were .com related during this time, literally first day trading on average, they would go up 60% on average, right? It's not like an outlier like Snowflake that had their IPO recently. It was like your average .com that had not proven anything yet, except that they could spend money. Were like basically, you know, I mean, babies, like these things, like, I can't, it's really difficult to even express how crazy this time was. But basically you could go from napkin to IPO in like less than 2 years and go public with barely any revenue. Like you had a multi-billion dollar company called Webvan. I also recommend that you guys do an internet search on that company. They go public, they reach a market cap in public markets, $8 billion shortly after their IPO. They had lifetime revenue of $395,000. And there's a reason why I gave you guys a pretty precise number. It's so crazy that I remember the number, right? It was a crazy time. People were very naive in their perspective of how promising and how quick that promise would materialize. And part of the reason that there was so much optimism was because investment banks were singing the praises of the potential of internet as well. So, you know, equity research for internet related stuff, everything was so optimistic. And so because of that, the market was willing to pay a high valuation for stuff to go public while it was still searching for product market fit, right? Well, guess what? If that's the market conditions, you'll probably get a bunch of sleazy people starting an internet company and trying to take advantage of that, right? So there was really a sketchy environment that arose at the time, bad incentives, special times to make a killing without really earning it, that led to a tremendous amount of IPOs, quick flip, really, IPOs in this sector. And I believe like the average .com that went public in, say, 1998 through 2000, the average .com lost 90% of their value. And I believe more of them failed within the next 2 years than survived, right? Now, how do you think investors in the public market felt after that happened to them? Yeah, they probably weren't too happy. How willing do you think they still were to let companies go public quickly? Yeah, probably not too much, right? How much do you think they trusted the research of equity research analysts that were closely tied to the investment banks doing the IPOs? Less trustworthy of that too, right? So like there was like a breakdown of some, like, by the way, like I will say this, right? Historically, what was the purpose of an investment bank that's taking companies public and producing research on it, right? In the good version of the world, the idea is the people doing the research should be providing unbiased research and should be doing the work for the public market to ascertain whether, what's gold and what's shit, right? The thing is, like, markets no longer believe that they would do that so well because they did such a terrible job doing it during the dot-com bubble. And I recommend that you guys look up, examples of star analysts in the internet sector that, ended up being discovered that they were writing glowing research reports and on the side writing emails saying, this is donkey shit, do a search. And this actually might be someone that you have heard about, Henry Blodgett. Have any of you guys heard of Henry Blodgett? So he's like a guy, like, I don't know, like he's now a media comment, like, I don't know, maybe he works for like CNBC or MSNBC. I don't remember which one he works for, but he's like a television personality and commenting on markets, and see what he did in the fucking dot-com bubble, right? He did that. He formally wrote X and informally wrote an email, not X. Very much not X, right? That breaks down our trust in the role of investment banks as the due diligence for a market, right? And if we don't trust that, but at the same time, we don't trust ourselves to be able to do the due diligence, then we just take a hard pass, right? So markets started taking a hard pass on stuff that isn't proven yet. In other words, stuff that isn't proven yet can't go public. So they must stay private longer, right? And that leads to stretching out of late stage funding. They don't go public because the market won't allow them to go public.
Gerard.
Yep.
I've got a question related to IPOs and stretching out funding. In the current environment, do you think there's any conclusions to draw from, one, the number of funding rounds of a startup's gone through pre-IPO, two, the actual size of the funding rounds, and three, the quality of the syndicates that provided funding, and how that would relate to performance in the current how that would relate to IPO performance.
There's a lot of conditionals and there's a lot of correlations embedded into your question. So the answer is I cannot answer that question. If I did, or if anyone did in the world, they would probably be bullshitting because there just isn't enough data to go into quite the level of detail that you're asking. But why don't we revisit this question as I continue talking through this, because I've just given you one thing, but I'm actually going to give you guys more things about the stretching out. And then I'll also tell you about consequences of the stretching out, which are material to the question that you're asking, okay? So a couple of other explanations for stretching out, right? So this is, to me, like ground zero of the stretching out is explanation one in my slide, right? Which I just, in words, gave much more elaborate detail on. And I mean, I think like the story I just told you is a very logical story, right? So hopefully it makes sense. But like most things in the world, it is not the only part of the story. And there are other things that also contributed to the stretching out of the late stage financing. And I would say two things that I want to point out are changes in regulation. And they were changes in regulation that had different effects on this choice of staying private versus going public, right? Because there's two things that can, like, this is just a logical framework. When I think, do you choose A or B? I think of it as a cost-benefit analysis. So if something, like A is stay private, B is go public. Well, if I do something that makes the benefit of going public higher, I'm going to go public sooner. If I do something that makes the cost of going public lower, I will also go public sooner, right? That seems like a truism, right? So basically, what are some reasons that things went public not sooner, as I was saying a second ago, but later? Well, it must be that there were things that either made the cost of staying private lower or made the benefit of staying private higher, right? So there's two important changes of regulation that had a material impact on the go public or stay private decision. One is Sarbanes-Oxley. I'm not going to give you guys a historical rundown on Sarbanes-Oxley. That one I actually think people should know because it still is a little bit more recent. And this is a big deal. If you've taken any accounting course, and they must have told you about Sarbanes-Oxley for financial accounting, it would defy my imagination that they wouldn't have done it. But what was Sarbanes-Oxley? It just basically changed the amount of disclosures you needed to make when you're a public company. It was a response to accounting scandals. Accounting scandals, regulators will say, you need to now disclose more stuff because we don't believe you anymore, or we don't trust your discretion. And that's what happened with Sarbanes-Oxley. It increased the amount of disclosures that public companies need to make. In other words, the cost of being public went up. And if the cost of going public goes up, then you stay private longer. Make sense? Right? So again, if you want more color in detail on that, just do your own search on Sarbanes-Oxley, oftentimes referred to as SOX, S-O-X, right? Now, another thing that changed things, this is a regulation from 2012, which is called the Jobs Act, which was Jumpstart Our Business Startups Act. This was a reaction, and it took a few years for things to materialize, but it was a reaction to the financial crisis. And it was really about trying to make it easier to generate growth by providing an attractive environment from a regulatory standpoint for startups, specifically in terms of things related to their relationships with investors. And so one of the things that the Jobs Act did is it made it easier for startups to delay going public. I need to give you guys a little bit of background on this. And this one I don't expect you guys to have learned in another course, so I will explain it. Which is there's one thing that people don't realize about disclosures, say around mandated in the US, let's say by the Securities and Exchange Commission, right? Like, look, companies don't file annual reports because they want to, it's because they are required to by law, right? Most of the time, right? Because it's expensive. You would rather not do it if you don't have to do it. You do it because you have to. And there's very good reasons for why regulators require that. If you want to know about that, learn about the era of financial markets before the creation of the SEC, and you'll see it's a wild west to say the least. But skipping to 2012, one thing that people don't realize about disclosure requirements, because almost everyone thinks of disclosure requirements as something that applies to publicly traded companies. And it's true because it does apply to them. But what most people don't realize is it actually applies to some non-publicly traded companies as well. So in particular, if you've got a private company and you become big enough, and I'll define what big enough means shortly, if you become big enough, even if you're not publicly traded, you must make public disclosures. So you're not traded on the stock market, but you still need to file your annual reports and stuff like that. So look, the moment you're forced to file annual reports, I mean, all of a sudden you start to say, well, I might as well go public anyway, because I'm going to have to bear those costs regardless. Does that kind of make sense, right? Because there are benefits to going public, enhanced liquidity and stuff like that, right? So there are conditions where a private company is forced to disclose like a public company. Now, the question is, when does that rule kick in? So prior to 2012, that rule would kick in the moment you have 500 investors. Okay. Now, you might think it's difficult to reach 500 investors, but like the way investors get counted at an individual VC level is not one VC is one investor. It's more nuanced than that. Sometimes it's going to be more than that. And there are, for instance, some employees that are going to be counted as an investor as well. If enough of your employees get counted as an investor, you can reach that 500 cutoff pretty quickly. And this actually became an issue for, say, companies like Facebook. I'll actually give you the best example of a situation where companies get into trouble with this. I'm an employee at Facebook, and I'm given shares. Depending on the contract that I have with Facebook, I may be allowed to sell those shares. If I sell it to an investor, they count as part of the 500. And one of the things we'll talk about later in this semester is the rise of secondary markets where employees have been able to trade their shares. And so like companies lost control of like how many shareholders they would have even, right? And so some companies then would have to make disclosures, right? Because they would hit the 500. And so like startups lobbied against that. And one of the things that the Jobs Act did is it moved the threshold from 500 to 2,000, which allowed them to stay private longer without needing to make public disclosures. In other words, it lowered the cost of staying private for some mature private companies. And so they could stay private longer. Make sense?
Do you think there's going to be a movement towards like relocating your headquarters just to avoid rules like that for startups within the US? Because I'd assume that that rule isn't there globally. There's only a few markets where it's enforced.
Look, I mean, you're asking a question more broadly that relates to making location decisions or decisions in general in the shadow of regulatory arbitrage, right? You can by choosing A or B, you're governed by different rules. Pick it to get the best rules for you. Could that happen? Yes. And that's probably one of the reasons why there was a willingness to change the rules, is that there was some worry that that might happen, right? Have I seen examples of companies that have actually like said, this is the reason that made us, like headquarter in Denmark instead of the Bay Area? I haven't heard of a company actually say that outright. So is it theoretically possible? Yes. Do I think it's a major thing? I'm a little bit more skeptical about that in this particular instance. But there are some settings where regulatory arbitrage is definitely important. Certainly around tax rules, right? Especially for companies that have a lot of wiggle room because they're an international conglomerate. But that's not the domain of startups, I would say. That's more domain of larger companies, and it's a different context. I like the question. I'm just not sure in this particular case that it's a first order factor, but that could always change, right? One of the reasons why I'm not too concerned that it's a factor in the U.S. is that the U.S. has basically unambiguously the strongest startup ecosystem in the world, which is the Bay Area. But at the moment you have another ecosystem that has favorable rules and similar qualities, then all of a sudden maybe that becomes a deciding factor, right? Just because I don't think it's played a role historically doesn't mean I'm throwing out the possibility that it could play a role in the future too, right? And again, like I view that as a particularly sensible justification for why the Jobs Act actually succeeded in getting passed, right? But let me be clear, I'm speculating on that regard. I am not privy to the discussions that occurred for justifying that rule. Like I just don't know it. I haven't explored it myself. So it's speculation. Sound good?
Yeah.
All right. So
do you mind if I quickly ask a question?
Sure.
Okay, so I think with Facebook's case, Goldman set up like a special purpose vehicle to like basically have all of the new liquidity go through that SPV and it kind of be considered as one investor for Facebook. At the time, I think when Facebook needed a bunch of capital raised, I think Goldman set up an SPV to get around that 500 count investor problem. So like in the eyes of our regulations, the SPV was one investor, but all the new investors own shares in the SPV. Like,
Yeah. So that I have no doubt happened, right? But the thing is, right, Facebook would rather not have to do that because that way they wouldn't have to pay Goldman as much money, right?
okay.
Goldman
Right.
does it, but that's because they're paid well for it, right? So the startup, that's like a Band-Aid on a wound when they would prefer to zap it with a special curing device that fix it all up, right? So Goldman, did a Band-Aid. Meanwhile, the Jobs Act, tried to go more to the heart of more to address the wound itself, right? But yeah, I mean, by the way, with the question you're asking, I would almost say the biggest lesson to get out of the thing that you mentioned is that when you spot a problem like this, it's an opportunity for you, if you're an investment banker, to create a line of business, right? And some of the best people in the world in making money for their investment bank are the ones that spot these opportunities so that they have an eye for a problem and they have the creativity to find a solution. They have a creativity to find the Band-Aid. And because the wounds tend to last a long time because regulation changes slowly, that Band-Aid can give you money for a while. I would love to be selling Band-Aids to big wounds, right? So a practical tip that I would say around that is pay attention for these pain points in markets and always ask yourself, once you identify a pain point, what solution can my line of business provide that would provide an adequate. This is a general statement about starting a business, right? But have that ethos, right? That's the main thing I get from the example you mentioned, and it's a good one, right? By the way, this pipelines nicely to the next thing that I want to talk about here, which is once we observe explanation 1, explanation 2, explanation 3, and its direct consequence, which is a stretching out of the late stage funding. Another thing that is useful to think about, and this I almost think is more important for you in your careers, is, okay, that's the reality of markets. How are institutions, how are business practices, how are careers going to change in light of these changes, right? Because the thing is, the stretching out of the life cycle is not the only thing that's been a really important change over the last 20 years. The stretching out of that life cycle has changed people's careers within financial services. And I want to highlight 2 examples here. These are what I call the consequences, 1 and 2, which is one consequence of this pattern or this shift on investment banking, and one consequence of this shift in investment banking, let's say. I said no. One is investment banking, the other one is investment management, okay? Let me start with the investment management one, right? We have a stretching out of the life cycle. There's an entire segment of investment management that is called growth equity. What does growth equity do? It tries to pick good, recently IPO'd or at IPO companies. That's traditionally what growth equity has as its bread and butter. And when they're doing it well, it basically means they're good at doing due diligence for companies that are about to go public or just recently went public. Now notice, if you were good at doing that in 1995 to 2000, that means you were good at doing it for a company that was kind of like a Series B company usually. Do we kind of agree with that statement so far? Because companies didn't raise that many rounds, right? So I was good at doing due diligence on a Series B. And I was good at taking that bet in the public market. Yes? Well, that creates a big problem if there's a stretching out of the private late stage, right? Because all of a sudden, there's nothing in the public market that's a Series B because they've all stayed private longer, right? If I don't change, I am now a dinosaur about to go extinct. Do we kind of agree with that too? So how do I have to react as a growth equity mutual fund in the early 2000s up through now? Because I got to change, right? Well, I need to start building a competency to find a way to invest in the private market, because my analytical skills are now located in the private market and not the public market. And guess what? We've seen that. You've seen the rise of growth, like large growth equity investing in the private market. If you want to see good examples of this, do a Google search on Tiger Global and its founder, Chase Coleman. Do a Google search on Coatue, C-O-A-T-U-E, Coatue Management, right? SoftBank, right? These are all folks that altered what a standard growth equity looks like, right? Relative to what it looked like in the late 90s, beginning of 2000. And it's a natural consequence of the stretching out life cycle. Why does that matter? It matters because now all of a sudden, if you are starting your career in growth equity, because people usually say, I want to go growth equity because I'm interested in in studying and deciding to invest in the new thing. I'm curious about those things. That's like the good reason to want to do growth equity, right? And so people who like to do that now need to realize it's not sufficient for me just to learn how to spot the new thing and do due diligence on it. I must also learn how to navigate the private market, which is far less democratic than the public market. Like, it's pretty easy. If I believe in a company, in the public market, it's easy for me to buy that company, place an order. We can maybe optimize the execution, but it's fucking place an order at the end of the day. Now, if I want to I believe in a private company and I want to invest in that private company, it is a hell of a lot more difficult. And I need to be well networked in the private market to be able to do this, right? And so that's an entire skill set that growth equity didn't need before and that it needs now. Why am I taking the time to say this? For your careers, I would recommend spotting trends like this, right? Because when you spot, to survive and not become an extinct dinosaur in this market that I want to be a part of, you want to spot those opportunities where there's a regime change. Folks who continue doing things the way they've done it traditionally are going to die. And folks who evolve the right way are going to be the new dominant players in this market, right? Like, that's the best thing that Chase Coleman did, right? So Chase Coleman, founder of Tiger Global, he realized that. He realized it sooner than almost anyone else. And that's brilliant. He realized like the way you execute on your core skill set as a growth equity investor has fundamentally changed. I am not focusing on the public market anymore, and I am going to figure out how to navigate the private market. Brilliant, brilliant. And it's about really understanding how the game has changed, right? And understanding like the game is changing this way because of explanation 1, 2, and 3, right? So like you want, like, this is, I don't know, it's not something that we talk about in classrooms much, but like this is super important. Like, some of the most successful people in financial services are the people who spot that the game is changing and have clarity on how they should change their skill development because of the changing game. So, you know, if you can, pay attention to that, right? So that's an example of how, as I said, growth equity investing has changed over the past 20 years. By the way, I mean, even look at growth equity mutual funds now, and what you'll find is they make investments in private markets as well. They used to only make investments in public markets. They now have no choice because they are no longer a traditional growth equity investor if they only invest in companies that go public, because now companies go public as a Series J, right? Then there's not as much growth potential at that stage as there used to be when they were a Series B or a Series C, right? So the world has evolved. And that's one of the reasons why it's so much, and notice, this is like a flywheel effect, right? Because the moment more money is coming into the private market, it then also makes it even easier to stretch it out longer, right? And that's why you see $1 billion funding round now, right? The only way you can get $1 billion funding round is if there's been a bunch more capital that's popped into the private market that isn't traditional VC. VCs, even as a syndicate, cannot fund $1 billion in a single round. I don't believe that has ever happened once. If someone knows an example and wants to tell me about it, fabulous. I'm sure you can probably find a counterexample, and I would like to know it, right? But that's a rarity. Every single mega round I've seen has one of these new generation players that would have been a public market investor in the past as opposed to a private market one. And that's big. Like, to me, like, the advice that I would give to someone preparing for being growth equity now is very different than the advice I would have given 20 years ago. Completely different. Well, there's some commonality in terms of the due diligence and the curiosity, but in terms of like the networking, I now say, like, you have to do it. You have no choice, right? And in the past, I would have said, whatever, don't bother, right? So the only networking you needed to do as a growth equity investor, pre-dot-com bubble bursting, was network with investment bankers so that they give you an IPO allocation. And now it's like totally different. So I don't know. I think it's important to be aware of these trends. Then the second consequence that I'll mention is about not the buy side, but more the sell side, right? So think about like how investment banking has changed or something, right? And like, what's been one consequence of a stretching out of the late private market? What do you think happened to overall IPO volume in terms of number of deals over the last 20 years?
Went down.
Sorry? I'm pretty sure I heard. Sorry?
Went down.
It went down. It didn't just go down a little bit, by the way. It went down a lot. And there were literally years where at least tech IPOs, like one or something like that, right? Like, that's bad news for investment bankers that are specialized in IPO, right? If literally the entire tech sector generates one tech IPO in a given year, even if it's Alibaba, it's still slim pickings for the technology investment banking sector as a whole, at least the side of it that is IPO focused, right? So, like, trust me, investment banks are good at surviving in regime changes. So you can also rest assured that they started thinking about other ways to make money. They weren't just sitting around saying IPO on their forehead and not doing anything, waiting, like, listening to the crickets. No, they proactively realized, like, holy cow, this is slim. We got to monetize in other ways. So what do you think the investment banks that would traditionally do stuff like that started doing? Well, instead of facilitating public IPOs, you have these things now called private IPOs. They're funding rounds, but there's such a large amount of money raised that it looks a little bit like an IPO, except that it's not trading in the public market afterwards, right? And they want to have a role in that. So they start inserting themselves into the process of late-stage financing roles by helping the startup match up now, not with the public market, but match up with the right large late-stage public investors, right? Again, examples being like a Tiger Global or a SoftBank. Also, these sovereign wealth funds, by the way, also make investments into this stuff, right? So investment banks have started playing a matchmaking role there within the private market instead of at this transition between the private and the public market. Makes sense, right? Because it is a common skill set, right? So the nature of these jobs have changed, and you should be aware of those things, because if the only thing you ever do in terms of skill development in your career is to listen to what people did 5 years ago, you potentially run the risk of having done the wrong stuff to prepare yourself for a regime change, right? So that's important. And I think this is a nice case study that I think illustrates that, because the people who recognize those things, both within investment banking and within investment management, put themselves in a position to be thriving in a much better manner when the world did change, right? And consistent with this, you see, right? Like, you see that, like, the people who spotted these trends and made the changes to their business model in anticipation of that reaped fabulous benefits. Again, just do a Google search on Chase Coleman net worth or something like that. And, like, the guy was a billionaire by the time he was 30 or something, right? Worked out well, good for him. Fabulous, right? So yeah, I mean, this thing changes, right? So what I'm saying in this lecture today, no guarantee that it persists into the future. By the way, flip side is like, you know, if SoftBank ends up being, if their vision fund ends up being a clusterfuck, well, then maybe there's going to be now no longer a stretching, but what's the opposite of stretching? You know, a
Contraction.
Contracting, exactly, that's the word, right? A contraction of the late stage fund. It's possible, right? I think time, you know, well, not I think, I know time will tell, but you know, one could see it going both ways. And I think it's useful to, one of the things I would pay attention to if I was in this market so that I had more current information on a regular basis would be to say, let me formulate a view on whether that's going to happen or not, and let me act accordingly, right? Folks okay with this? All right, so that's what I wanted to say about funding life cycle. It did go a little bit longer than I expected, but that's okay. You guys asked good questions. Several questions that I never thought about before, so that's a good thing. I got something out of it. Now what I want to do is talk about the process of exit. And I think in today's lecture, just in the interest of all of our stamina, I will just talk at a high level about IPOs and acquisitions and some of the factors that go into the choice of doing one or the other, and maybe also a little bit the timing. And then the nitty-gritty details about the IPO, I will post on an externally recorded video instead of something like this with you guys. Sound okay? All right, you guys are all like, yes, thank God. Okay, so in any case, yeah, look, first of all, what I want to emphasize, I've emphasized it before, but it's so important that I'll keep on emphasizing it, is that an exit is supremely, supremely important for the functioning of the VC market, the startup financing market, because it is the liquidity event for investors. And if investors don't think they'll get a liquidity event, good luck getting money from them. So this is the, whatever, this is the horse that drags the cart or something like that, right? I'm not sure if that's an actual term. I just made it up on the fly. Probably is a term though. In any case, so, you know, again, first of all, what's an exit? You know, an exit itself, it is about liquidity from the perspective of the investor. So it really is what a partial or a total sale of the startup that provides better options for short-term liquidity, most important to its investors, but it can also be liquidity to the founders who only have really paper wealth until a liquidity event occurs, and same thing for employees, right? So this liquidity is important to actually get your financial payoff eventually. And there's two categories of these types of liquidity events. There's an acquisition where you just get rolled into another company, or there's an IPO exit where you don't get rolled into another company. You're still that same company. It's just now there's some new holders, and you have, you know, you start having, you know, active trading in the shares of your market. An acquisition is almost always a total sale of the startup. Meanwhile, an IPO is always a partial sale of the company, because basically in the IPO, only some shares are issued. Most of them are still held by the investors. In fact, most of the time in an IPO, right, the new shares that are issued are actually, sorry, the shares that are issued to the public are actually brand new shares. So actually the IPO itself is not the liquidity event to the investors and the owners of the company. That liquidity event only happens later on when all the owners of the original shares are finally allowed to trade the shares, which, by the way, doesn't happen the moment the shares start trading in the market. In an IPO, there's something in the IPO contract that's called a lockup provision that basically says all the owners of the shares before, especially the insiders of the company, so its founders, its key employees, and its VCs, must hold on to their shares for at least X amount of time following the IPO. Right? So with an IPO, actually, the liquidity event only happens with a lag for all of these people if they want to sell out. And I'll talk more about the mechanics of the IPO transaction when in a separately posted video a little bit later on. right? But just know, these exits can be either partial or total sales. And the total sales really are the domain of an acquisition, and the partial sales are really the domain of an IPO for the most part. There is a little bit more richness to what I'm describing here, because there is the rise of SPACs, which are kind of a new kind of acquisition. And there is a rise of the direct listing IPO, which has got some important differences vis-a-vis the traditional IPO. So in this discussion here, I'm really thinking mostly about the traditional IPO and the traditional acquisition, okay? So again, as I said, why are exits vital? The exits are vital because they provide an opportunity for a return on investment to the key stakeholders of the company. And that's important for incentivizing us to do any of this stuff in the first place, right? For investors, this is particularly important. And it's particularly important because investors in startups, so let's take an example of VC. A VC makes their investment into a startup via a VC fund, a specific fund. And these funds, their funds are a contract between the VC and the limited partners that give money to the VC. And VC funds, like pretty much all private equity funds, have a finite lifespan. In other words, if I'm the VC and Mike is my limited partner, our contract is going to say, I am committing to Mike to return all the money within X number of years, where X is almost always 10 years in VC. So I need a liquidity event within 10 years, right? And so exit is important. If I don't think there are prospects to exit, this is a problem for me and my fund, right? So this is supremely important for VCs, right? And look, that lump sum payoff from exit is also like much, I would say even more important in VC than it would be in other forms of PE, where like other forms of PE maybe invest into cash cows. Why? Because, hey, at least with a cash cow, you're making money in the middle anyway, because profits are being popped back to you. But with a startup, they're not popping any money back to you anytime. So your one and only is the exit, right? That's almost always the case with startups, right? So this exit stuff, like, one cannot underscore how important this is. And understanding it and keeping track of it is super important for all stakeholders involved, but especially the investors. Okay? So it's useful to think about, it's useful to be familiar with these exits. It's also useful to think about the choice surrounding exit, right? And there's two dimensions of the choice that are important. One is, if you're going to exit, what type of exit should you pick? And then the other one is the timing of exit. Okay, so I'll talk a little bit at a high level about both of those decisions. First thing I'm going to say is not that interesting, but I'll say it anyway, right? We potentially might be thinking about the choice between an acquisition or an IPO, but it's not always a choice. Sometimes there's only one that's available to us. And in particular, sometimes the only thing we've got, if we want to do an exit, is an acquisition. Okay, so when you've got young startups exiting, it's almost always an acquisition because the startup is not IPO ready, where, as we discussed earlier, the definition of IPO ready has become a more mature company now than it used to be, right? So quick exits are almost always like over 99%, almost always acquisition exits. And really early on, it might even be, acquisitions that are not so much about the company, but are about the talent in the company. Something called an acqui-hire, an acquisition that's really just, called an acquisition, but is actually just hiring a whole team, and you'll use them to do something else in your company. Really, really quick acquisitions, non-negligibly often are of that type, right? So sometimes you don't have a choice in saying, I want to do IPO or acquisition. You just have one option, and it's almost always, in that case, going to be an acquisition, right? But when a company becomes more mature, then, once it's sufficiently mature, i.e. you want to, on that dimension, reference to an understanding of what it means to be IPO ready in the market. And let's keep in mind the definition of IPO ready changes over time. Systematically different now than it used to be in the late 90s, early 2000s, right? But once you're mature enough that you've crossed that IPO ready threshold, then it's a choice. And then the question is, what governs that choice, right? If both options are available, what are the things you consider when you decide acquisition versus IPO, right? And so I'll talk about some of them. They're not meant to be that subtle. So I'm just laying them out so that we've discussed them. One, I hope we're not surprised about this, is financial considerations, right? So you want to think like, if I do an IPO versus if I do an acquisition, how much is the total payout, right? So obviously part of it should be which one's higher. Now, the thing is, there isn't a systematic answer on which one's going to be higher. I would say that on average, it's likely to be a bit higher with IPOs, but not a universal rule. Why? Because there's a few factors that go into the financial that are going to be a little bit different across different companies, right? So like an acquisition could be more financially attractive because your startup has some special synergies with the acquirer that don't get materialized if you go public as a standalone. Right? So that's something that could shift things in the favor of an acquisition, right? Another thing, and this is going to be discussed when we talk about the going public process in more detail, but when companies go public, they go public at a discount. They are underpriced. That's an extra cost of going public. And so you should keep that in mind when you're going public, is that you're paying actually real money to the investment bankers involved in the process. You need to give extra goodies to the people buying in this market for some reason or another. This is a bit controversial, to make that going public transaction happen. And that may offset the benefits you get later on from being a standalone public company. Sometimes you want to go public because the public market is overheated, right? There's a bubble. Think of all the companies that were rushing to go public during, like all the .com companies that were rushing to go public during the .com bubble. It's because they just had this golden opportunity to sell themselves too expensive to the market, right? Sometimes that's why you go public. That's a fact of life. You might as well consider it as a possibility, right? That, you know, so long as you don't lie about stuff, it's not illegal to do it, right? I'm not going to look down on someone who goes public at too high a price, but does it in an honest way, because guess what? I was an equity prop trader. My goal was to find someone that I would be selling stuff at too high a price or buying stuff at too low of a price. So I can't morally judge someone doing that in the context of an IPO, so long as you don't lie or break the law. So that can be a justification, right? We are all adults in this market, right? And you know, it also could be just not mispricing, but it could just be differential belief. If you are super optimistic about the future and the market, both acquirers and public markets don't have that same optimism that you do, well then by all means sell as little of the company as you need to. So do the IPO because it's a partial sale as opposed to a complete sale, right? That's another thing that could govern the financial consideration. Right? So I might be more willing to sell 10% of my company at $1 billion valuation if I think it's worth $2 billion than to sell 100% of the company at a $1.1 billion valuation, right? That's all I'm saying in that last point here. Because I'm like, eventually the market will align up with my view. And so I'd rather sell 10% and get 100 million now, and then later on sell the remaining 90% at 1.8 billion, which is 90% of 2 billion. That'll give me a total of 1.9 billion. Meanwhile, if I sold 100% at 1.1 billion right now, I've made 1.1 billion. So even though I could have gotten acquired at a higher valuation, right? I'm still better off having sold less at a lower valuation. That's all I'm saying, right? Make sense? So these are all considerations to keep in mind, right? I just basically tried to break down the financial considerations into different little morsels. Okay? Look, related to, I'm going to skip the second point now and get back to it in a second, but related to the financial consideration is also transaction cost considerations. I basically kind of accidentally said it in my earlier bullet anyway, which is like, look, fees for going public are higher than fees for acquisition. So the transaction cost consideration systematically favors an acquisition over an IPO. So the question is whether the other stuff offsets that transaction cost consideration. So far, so good? Here's another thing that you just have to keep in mind when you as a founder are thinking about how you want to exit, which is also control considerations, because that's another thing that's really different depending on whether you get acquired or whether you go public. When you go public, you still control the company. You are the CEO, right? You get to make decisions. You get acquired by Amazon, you are not making the decisions. There's this fella called Jeff Bezos who can kind of tell you to go screw yourself if he disagrees with you, right? And that's a big deal, by the way, because for founders, this is their baby. They have put a ton of blood, sweat, and tears into this. And losing control on it is not it's not a little deal. It matters, and it has a value that you should consider and compare to the financial, right? Because you get acquired, you do not have control. And by the way, most of the time when companies get acquired, the founders of that company within 2 years are going to be gone from the company that acquired them. In other words, they have zero control. They are gone, right? And so if control matters to you, and it's a fair thing to say that it does, keep that in mind when you're making this decision. I've met plenty of founders that have a certain amount of regret of having accepted an acquisition offer and felt like they weren't able to achieve the vision that they had when doing it in the first place. Even when they're set for life afterwards, that part still hurts a bit. And so important to keep in mind. I have no way to pin a number on that, by the way, right? This is all kind of gut qualitative stuff. But just because you can't quantify it doesn't mean you shouldn't think about it. And every founder making this decision should think about that. So far, so good? Right, look, another thing I want to talk about is timing of exit. Because there's a more nuanced exit decision. And which is like, when do you exit? And I'm going to focus on a specific manifestation of this timing decision that I think is particularly interesting, which is sometimes the only exit you have on the table right now is an acquisition, right? A company comes to you and says, we want to acquire you. Nothing you can do about IPO because you're not IPO ready. And so then you start to have to decide, do I want to say yes to the acquisition now? Or do I want to say no and take a chance, hopefully getting an IPO exit later? That's actually a very common thing because if you're a startup that is doing very well, trust me, there are large incumbents that are going to think about, do we want to try to acquire this company? And oftentimes they're going to want to do it before you have any hope of going public, because it makes the decision a little bit more compelling to you, or the option of exiting becomes a little bit more compelling because you can't play that other option off on them in negotiation, right? And so the question is, well, how should you think about that problem? That actually seems like a particularly tough one to me, right? And to me, I think, look, choice of, what do they say? Like, it's like a bird in hand or two in the bush or something like that, right? Right? Do you want one bird for sure, nice roasted? Or, do you want to hope that maybe you might get 0, but you might get 2 or something like that, right? Aim for a larger, I could be an acquisition, but oftentimes hoping to swing for the fences and get that IPO in the future. Obviously, risk plays a role here because it's no guarantee that you're going to achieve that positive latter outcome, right? And so keep that in mind. Risk aversion plays a role. Risk aversion is not the only thing that plays a role here, right? Another thing that plays a role is liquidity considerations, because right now, like liquidity issue. Look, at the end of the day, you being a startup founder and all your employees who own shares in your startup, you guys are holding an illiquid thing, right? One benefit of taking the money now is all of a sudden you've got liquidity, right? And you can actually start spending that what used to be formerly paper wealth, right? I mean, this changed. I'll mention a little bit, right? So now, like founders, at least, it's more difficult for employees, but founders at least can now sometimes, when they raise a funding round, sell a little bit of their shares and get some liquidity. So I have a friend, he's actually a McGill dropout, called Rémi Richard. He's a founder of a base, I won't mention the company specifically here, but it's basically a health IT, a Montreal-based startup. And like he had to look at this decision of like, he has founder shares in something, it's worth a lot on paper, it's worth retirement money on paper, but he has no actual money. And so in his most recent funding round, right, both him and his co-founder took a certain amount of their founder shares and sold it to the investors just to give them the bare minimum amount of money they need to be able to buy a house and have a bit of consumption money, because they're not paying themselves a high salary along the way. Like his wealth compared to what he can spend right now, it used to be an insane differential, and now it's still a pretty big differential, but the fact that he could sell a bit of his shares in the funding round made a huge difference. That's becoming more and more common, which makes the liquidity consideration a little bit less important now than it used to be, by the way, right? Which also leads to companies swinging for the fence a little bit more too, by the way. I probably should have mentioned his actual name here, and he's probably okay with it. But in any case, so some of these things, what's my point of saying this is some of these things change over time, depending on how deal-making practices change, how markets, how markets change. So this practice of selling some founder shares in a funding round alleviates the liquidity constraint, right? Another thing that's alleviated it is the rise of private secondary markets. I won't discuss this in the lectures, but I do believe that I have a slide on this. Oh no. I took the slide out between last year and this year because I didn't talk about it last year, but maybe I'll post something on my courses, an announcement that shows a video where one particular VC from Sequoia, Doug Leone, talks a bit about the rise of secondary markets and how that has changed the liquidity concern of founders as well, and led to less acceptance of earlier acquisition offers. Okay. Well, I do have a little remark at the bottom that just says what I said. So I think this proves that I don't read my slides while I'm talking to you guys, because my slides are here, you guys are here, I'm looking at you. But in any case, or I'm looking at me because I see myself at the same time too. Okay, I don't know why I said that. So now what I'll do is I'll just end our discussion on this topic by just referring to two slides that I've got on my slide that are, one is a link to a podcast by Andreessen Horowitz. The other one is a link to one of my favorite sources of casual learning, which is YouTube, that actually have real world executives that were faced with this decision, talking about the nuances of their decision. Because I don't want to give you this weird, simplistic and naive academic ivory tower feel that everything boils down to just these two nerdy considerations that are bread and butter finance, right? Because risk and liquidity are two of the central themes in finance. And guess what? This decision is not just a purely financial decision. There is much more to it than that. And the two examples I'm about to state do highlight that nicely. And I'll actually first start with the second example that I have here, which is the example of Facebook. And Facebook actually faced this decision. Do you accept an acquisition offer relatively early, or do you swing for the fences? And I think we know what decision was eventually made, right? The early acquisition was not an acquisition offer to laugh at. It was an acquisition offer by Yahoo to buy Facebook for $1 billion, either just after or just before their Series A round. I think it was just after. Yeah, no, it was definitely after. It was after their Series A, but it was before their Series B. So pretty quick. Someone offers me $1 billion that quick, it's a tempting thing. I don't just, tell the acquirer to bugger off on a whim, right? And Zuckerberg has an interesting statement about that decision with him. And it's less about the decision he made, and it's more about a consequence of that decision. And so the video that I linked to here, he says what I'm about to say. But basically what he says is that there was a consequence to him declining the Yahoo offer. And the thing is, when he declined the offer, many of his key employees, especially the non-engineer ones, were livid, were pissed, because they were like, my God, you could have said yes to this and I could retire. So all the business side employees of Facebook, the most important ones, all were extremely upset, and many of them in the next year left the company. So that's, by the way, highlights a potential cost of saying no to the early acquisition offer, is that it can actually hurt your ability to succeed. Now, obviously that didn't kill Facebook because we know what Facebook became, but at the time it could have hurt them bad, right? I'm sure the executives that left will never ever get over it, right? Because they would have not been millionaires; they would have been 100 millionaires if they had not actually gotten pissed off and left. But this is a cost, and actually the main lesson that I get out of this example is actually a lesson about management and communication in a startup, which is, you probably want to know that if someone comes with a very attractive offer today, are you going to accept it or not? And you better make sure that your employees know that. Because if that comes in and you make a decision that they don't expect, it can actually hurt your ability to really thrive afterwards if they choose to leave, right? It's a possibility. Again, it did not happen for Facebook because Facebook was just such a, I mean, for, like in terms of like aggressive scaling and go to market, things went about as nicely as they possibly could for them. But, there's a version of the world where all that executive turnover could have been a problem for them. Not every startup is as lucky as Facebook, where they can overcome that. And so as a startup founder, you should put yourself in a position in terms of how you communicate with your employees so that the decision that you make doesn't blindside them. Make sense? Right? No, this is not finance. This is like culture, sociology, or all this stuff that I'm not too aware of. But like Zuckerberg says it, I kind of believe it, even though he looks like an android or something. Oh, I should have said that. In any case, next example is the example of OpenTable, right? That's basically online booking of from the consumer side, from our side as people who consume restaurant. It's a fabulous way for us to book spots and get some sort of rewards from having done that. On the restaurant side, it's a way to secure, business flow, and it's also a useful restaurant management tool in the back end for them. So OpenTable is a company that was started in the either just before or in the aftermath of the dot-com bubble, and really stayed as a private company for a long time because there was a bunch of turmoil in the IPO market, especially around internet and technology stuff. And so they stayed private for a long time. And so because of that, they had to think a lot about like, well, when will we actually do this? When will we do this? And in talking about this is a pretty long podcast, by the way, and there's a lot of juicy tidbits in it. But the part of the podcast that that is most relevant to our discussion here was one statement that Jeff Jordan. So Jeff Jordan was not the founder of OpenTable, but he was the CEO of OpenTable when it went public, and in some of its key survival phases. He's now a general partner at Andreessen Horowitz, so he's now a venture capitalist. But he's talking about his, the going public process for OpenTable, and one of the things that he mentions, and I think this is actually very much true in terms of going public, is he says that when OpenTable went public, they made sure that they had a couple of growth initiatives that they felt very confident about that would pretty much guarantee that they wouldn't fail to meet analyst expectations for at least roughly a year after going public. That's what I call revenue tricks in the bag, right? Because one of the things that happens when you go public is that you're a little bit more subject to short-termism. And in particular, you get punished in the market if you miss expectations, right? And that can lead to problems for your company because now you can't focus on really what matters. You have to focus a bunch of effort on assuaging the concerns and outrage of the market. That's a headache. That's a pain in the ass. If every quarter someone was screaming at me for every little thing that I missed, that wouldn't be fun, right? And it would be distracting on my ability to create value, right? And that's something that people should always think about when they're thinking about going public is, can they deal with that? Do they want to deal with that, right? And are they in a position where they don't need to worry about it too much for a certain amount of time? And if they don't need to worry about it too much for a certain amount of time, it makes it easier to do the IPO. And for OpenTable, Jeff says that was important, right? And guess what? It makes sense to me. And so that's another consideration. That this is actually a finance consideration now that I say it out loud, right? But it's kind of a much more subtle one than the broad classifications that I said about risk consideration and liquidity. I mean, this is a risk consideration. It's just not the obvious one that we were thinking about before. Because the obvious one before was it's less risky to go public, right? Meanwhile, this says, well, in some way, it is actually a little bit risky to go public because you got to deal with short-termism, right? Right? And it actually does highlight nicely, I think, that there's just a lot of nuance in all of this stuff in general, right? So, and so that's one of the reasons why I actually like to look at specific case studies like these, because it uncovers stuff that's more nuanced than the simple theories that I tend to come up with as a, finance trained ivory tower, nerd, right? And I hope that my course highlights that it's actually useful to do both. Think of things in terms of broad bread and butter themes like this, and it's useful to think about specific examples that uncover nuance like these, and uncover the reality that the real world does have a lot of nuance, and you need to be able to spot it, right? So, so yeah, that basically summarizes what I wanted to say about the exit decision in terms of, acquisition now versus maybe IPO later, or acquisition versus IPO. Again, this is all pretty high level stuff, right? I'm not here giving you guys a valuation apparatus that claims to make the decision for you, because that doesn't exist, right? So this is not formulaic, right? There's a qualitative aspect to trying to balance these different considerations, and it's not really possible to go more formulaic than that, right? But hopefully, in this discussion, it's either synthesized things you already know about these decisions, or it's made you better appreciate what the most important questions to ask around that decision are. Sound good? Any final questions, or are we good for today?